All right, so good afternoon, everyone. We request everyone to please rise and sing our national anthem.
Mga kababayan, ang pambansang awit ng Pilipinas.
Magiting sa manlulupin, di ka masisingil sa nagagang tutok sa simulan. Sa langit ang pagkaw ay hinatang tulakaw sa pagkayang minamahal. Ang isang ng matawad mo'y tagumpay na nagtitingin. Ang ituwin at araw niya kailan ang ay di magtitingin. Lumang ang araw ng warhagit pagsinta. Buhay langit sa piling ko, ang inigaya ng pagkaibang akin, ang mamatay ng dahil sa'yo.
Good afternoon, everyone. My name is Jessie De La Cruz, Sales and Marketing Senior Specialist of Think Tank. Thank you all for joining us today for this online seminar entitled Transfer Pricing in the Philippines, Laws and Practices. Before we get started, let's go over some online etiquette to ensure a smooth and productive session. To minimize background noise, please keep your microphone muted unless you are speaking. The chat feature should be used for relevant questions or comments. Please refrain from unnecessary conversation during the session. If you have questions or comment that may interrupt the speaker, kindly use the raise your hand feature in the Microsoft Teams. Kindly ensure your camera remains on during the session to foster engagement and collaborative environment. If requested, please share your feedback regarding the session. Your input is valuable for improving future training programs. Should you have any questions or require clarification, please reach out after the session. Welcome everyone to our Think Tank training session. To start, we would like to acknowledge our brand partners, Think Tank Outsourcing, your Palakad partner that helps companies register with SEC, LGU, BIR, DOLE, SSS, PhilHealth, Pag-ibig, and other government agencies. AAB and Partners, an accounting firm that helps business with accounting, taxation, audit, and government compliance. ThinkTech Solution, an Odoo accredited partner in the Philippines that implements computerized accounting system and BIR accreditation. Rich Payday, a managed payroll solution provider. And lastly, Global Transfer Pricing Network or GTPN. It is a global advisory firm specializing in transfer pricing, international tax, and cross-border structuring. It is founded by Big Four alumni. GTPN delivers partner-led, technology-enabled solutions to help businesses manage global tax compliance and structure operations and jurisdiction. Passing now the virtual floor to Mr. Aaron Aitana.
Good afternoon, good evening, good morning, everybody, wherever you're from, whether you're from the Philippines or you're from somewhere else here in the world. My name is Aaron Aitona. I'm the director of Think Tank PH Services, and we welcome you all in this one of a kind Think Tank MGB collaborative webinar where we invite professional experts from around the world to talk about practical business topics. So first off, I just want to talk about what MGB is all about. So MGB is a B2B connecting platform, which Think Tank is a member of. So we are collaborative teams from around the world. So for example, with Think Tank, we are the member of the compliance accounting chapter, where we are in connection with other accounting experts from around the world. And the nice thing about MGB is that we represent our own country. So for Think Tank, we represent the Philippines. And then Rishabh, who's going to be speaking along with his partner, will be representing the UAE, so on and so forth. So it is an excellent B2B connecting platform, allowing your business to tap into the resources and expertise of other professionals from around the world. So if any of you guys are interested in joining our organization, feel free to ask us after this presentation. So without further ado, I would like to introduce our speakers for today. So first off, I am honored to introduce Mr. Praneeth Narahari. And Praneeth is a global transfer pricing and structuring advisory leader at GTPN with over 12 years of experience in transfer pricing, cross-border structuring, and international tax advisory. A former Big Four professional, he has led large TP teams across the Asia Pacific region and the Middle East and has advised clients in more than 30 countries, delivering pragmatic, business-led solutions across the enterprise lifecycle. And our second expert is Mr. Rishabh Agarwal. And Mr. Agarwal is a corporate structuring advisory leader, also at GTPN, and is a chartered accountant specializing in international tax, BEPS, and transfer pricing. An All India rank holder and LLM graduate in international taxation. He is a trusted advisor to multinational companies known for combining technical depth with commercially focused, forward-looking tax strategies. So let's all give a warm welcome to Mr. Praneeth and Rishabh. So on to you guys. Go ahead.
Thanks, Aaron.
Thanks, Aaron, for the introduction and setting the context for today's discussion. I hope you guys are able to see this slide deck. Yeah, so before jumping on to Philippines context, at the outset, I just want to highlight that the transpricing frameworks across Asia Pacific and Middle East are largely aligned to the OECD transpricing principles. So all the ground rules, be it the FAR analysis, benchmarking, comparability analysis, the contents of the transpricing documentation are largely aligned across the jurisdiction. What really differs is in terms of the local intricacies, be it the documentation formats, threshold criteria, the timelines. But again, as I said, largely the ground rules are the same. Today, we'll take Philippines as case study because we have large portion of audience based in Philippines. Again, we'll share practical insights that are relevant across Asia Pacific and Middle East. So with that context, let's jump into the transpricing discussion today. At the outset, I want to give a big picture of the entire transpricing life cycle so that we don't get lost in the discussion. If you see, there are 6 boxes. Let me take you through this slide with a simple example. Say there is a back office shared support center in Philippines, which is providing captive services to a US parent. Now, since it's a US holdco and Philippines subco relationship, and there is a provision of services between 2 group entities, which we call as related parties from a transpricing parlance, the TP regulations will come into play. Now, a typical life cycle follows this way. First one is the TP structuring and benchmarking. Again, the structuring word is an exciting word because most of us might think that transpricing is more of a documentation or a compliance subject. But what I want to emphasize, which you will understand as we go through the slides, is it's more of a strategic tool rather than a compliance tick the box kind of obligation. So in the first step, we have to understand the nature of services, the business objectives, who is billing the clients, where is the cost center. Based on that, we set the TP policy. In our example, since it's a cost plus entity, captive entity, which is a cost center, which doesn't do any billing to third parties, the parent entity, which is the client facing entity and principal, will have to remunerate this cost center so that it pays off its monthly expenses, be it payroll cost, the operational expenses. So the entire cost base gets recovered along with the markup. This markup element is where the TP benchmarking rules or guidelines will come into play. Whether it has to be 8% or 12%, it largely depends upon the entire scope of services this cost center will be providing. Again, we'll have to compare with the industry trends or the margins which we get from the third party databases. The first is the benchmarking, the overall structuring. Then comes the TP policy setting, where we formalize this arrangement by way of intercompany agreement, which defines the scope of services, the cost base, whether you have to mark up the entire cost, which is your direct cost, payroll cost, and also overheads. And then how should be the invoicing? Should it be monthly, quarterly, half yearly, or annually? And currency of the invoicing, what should be the credit period? The entire contractual framework will be documented in this intercompany agreement. Then comes the implementation, where the back office actually starts rendering the services and does the monthly billing on a cost plus basis, as per the intercompany agreement and TP benchmarking that we would have undertaken in step one and step two. Once we do this month on month or quarterly monitoring, at the year end, which is the fourth step, before the closure of financials, one of the key aspect is to ensure that your actual results are tested against the TP benchmarks. Any shortfall is covered up in terms of year-end audit entry, which is true up, true down adjustments from a transparency standpoint. So, in our example, if cost plus 10% markup is the TP policy, and as per the provisional financials before the audit sign off, if we see that the results are landing at 9.5, there is a gap of 0.5%, which we have to do as a year end billing to ensure that the actual results will align with the year end with the TP policy, which is cost plus 10%. So once this is done, that's where the year-end transferring compliance obligations will trigger. In Philippines, we have the RPT, which is the Related Party Transactions Form 1709, which is filed along with the tax return. And there is also a local file, which kind of documents this entire analysis. So once we do the timely and holistic compliance, the obligations from taxpayer are done. That's where we leave it open to the tax authority to see if there is any audit based on the risk parameters they identify. So this is a big picture of overall transparency life cycle. We'll well into each of these pieces in the ensuing slides. Now, in terms of overall evolution of transparency landscape in Philippines, the initial code was established in 1939, where the tax authorities had authority to adjust the related party transactions if they're not if the results are not aligned to the independent scenario, which is uncontrolled scenario. Then there was initial introduction of TP audit guidelines in 98. Specifically in 2013, there was a uh, dramatic shift when the Philippines TP guidelines were aligned to the OECD TP guidelines. From there on, there were gradual additions or strengthening of the TP audit framework. Specifically in 2020, the compliance requirements have got more stricter because there were clear thresholds, timelines laid out, which I've explained, which is the RPT form and also the documentation guidelines. Uh, at the core of the entire legislation, if you see, there is the arm's length framework. That's where it triggers the burden on the taxpayers to ensure that your related party transactions are aligned with the arm's length principle. What will happen if you don't do? Then the tax authorities will do the adjustments, will increase your profits and increase the tax base, leading to the transferring additional tax cash outflows and penalties in case of non-compliance with the ALP principle. As I said, the OECD alignment emphasizes that it's not only the year-end transparency documentation checklist you have to meet, but the entire life cycle, right from benchmarking, intercompany agreement, implementation, the year-end arm's length check. So all these rules are emanating from the OECD guidelines. And the last but not the least, the RNTP compliance obligation will highlight what are the timelines, thresholds when Rishabh takes up this RNTP compliance requirements. Next slide, Rishabh. Yeah. So in terms of the coverage or the scope of transposing regulations, traditionally, as we all understand, the cross-border related party transactions. Uh, in our example, the subco, which is a cost center in Philippines, is providing services to Holdco, parent in US, which is a cross-border transaction of provision of services. So that is covered. There are a lot of examples like royalty or management fee to a principal, which is based outside Philippines. So these traditional cross-border transactions are covered because this is where there is a possibility of shifting profits from Philippines to any other low tax jurisdiction, reducing the tax base, thereby not giving the actual tax rights to the Philippines tax jurisdiction based on the value that you're creating from that economy. So to put a tab on that, there is a transferring applicability on cross-border transactions. In addition to that, okay, there is also TP on the domestic transactions. This is not common across the jurisdictions where TP is also applicable for the domestic related party transactions. The reason that it's there in Philippines because there is still a possibility of tax planning, especially if the two entities have different tax rates because of the local tax incentives or enhanced tax deductions or concessional tax rates. Still, there is a the tax planning possible with between two domestic group entities. Again, to put a tab on this, there is a compliance burden in terms of the overall transparency regulations. So to sum it up, the TP is applicable for both cross-border as well as domestic transaction. That's on the coverage. Now, let's see when two entities would be called as related parties, thereby triggering the transcribing legislative requirements in Philippines. Again, typically all uh, the the legal shareholding triggered structures, which is holdco and subsidiary, that's where the two entities becomes related parties. In addition to that, that's where the Philippines transcribing legislation is more exhaustive. It sees substance over form. It's not only the shareholding or a kind of capital criteria, but also the control and significant influence. It could be triggered because of the individuals who are the decision makers in the entities or the entities itself. So if you have to go uh, clause by clause, the first thing is where there are KMP or individuals who are sitting as the decision makers, calling the shots for these entities, since they can influence the pricing and the profits for these entities. They themselves becomes the related party for the entities. So this is more of a control or a significant influence criteria. The third leg is the typical holdco and subsidiary structure. If you go to the next slide, it's not only holding and subsidiary, but also partial ownerships in terms of associates and joint ventures. Even there, the entities become related parties. So apart from these relations which are emanating from a single entity water flow structure, there could be scenarios where there are two different group entities, but they are commonly controlled by a single individual. Okay, if you see the middle box, there is Mr. A who is controlling both entity X and Y. So this X and Y could be of different group entities, but still they are related parties because there is a common connect in terms of control and decision making. That will trigger the related party relationship between X and Y because of A being the common connect in terms of control and significant influence. And there is a miscellaneous or residuary clause where the employee benefit plans or the entities providing KMP services are also related parties based on the definitions. So these clauses will define when the entities are related parties, and that's where the TP regulations will start. The next slide. Uh, this again is an interesting slide because it captures the transpricing methods, which are again OECD aligned. If you see, there are 6 methods. To make it simple for understanding, uh, you can test the margins or prices at a transaction level or entity level. Say suppose if company is selling a mobile phone to a related party as well as third party. Now you have two options: whether compare the price to price, which is price per mobile phone between a related party and a third party, or if it is a distributor, compare the gross or net margins. Okay, instead of testing the prices, you can test the margins. So based on which layer you are testing, is it a price? Is it a gross margin? Is it a net margin? That will drive the TP methodology. So if you see the first method, comparable uncontrolled price method, the name itself highlights the word price, which means that it is a price testing and not a profit testing mechanism. This is typically applied in cases of any interest that you pay on the intragroup financing, where you test the interest rate with the comparable financing agreements, and based on the key factors like the purpose of loan, currency, the cost of funds to the lender, credit worthiness of the borrower, the industry in which the borrower is operating. So all these factors will be deciding the interest rate which is emanating from the comparable agreement. So you are doing agreement to agreement comparison. That's where the comparable uncontrolled price will be the most appropriate TP method. The same logic applies for royalties, where you are comparing the related party royalty rate for any brand licensing or know-how licensing with the comparable IP agreements, which have similar characteristics as that of a related party transaction. Second thing is the resale price method. Here, the word resale is akin to a distribution or trading activity. So whenever, say, a Philippines trading entity is buying and buying from a related party and selling to the local third-party customers, where it's just doing a buy and sell activity without doing any value addition, which is tweaking the form and characteristics of the goods that it is trading. Since there is no value addition, the overheads or the indirect expenses doesn't have any much bearing on the profitability testing or comparability analysis. So here the gross profit, uh, which is your sales less cost of goods sold, the GP itself is a relevant base for testing your profitability against the similar distributors or traders in the industry. So that's where the resale price will come into play in terms of a pure buy sell traders or distributors. Third is the cost plus method. This is not regularly applied because the use cases or the applications which are highlighted in the OECD guidelines as well as the Philippines TP regulations say that it could be applied in a case where there are semi-finished goods which are transferred from one unit to another unit, which are operating as contract manufacturers, where you have the unit economics in place, which is your overall cost of goods sold. So if you have those unit economics in place, you add a gross margin on that and determine the sale price to the other unit, which is in turn doing a value addition and selling. So here the methodology is overall cost of production plus a markup. So that's why it's called cost plus method, which is typically applied in case of contract manufacturers, which are again doing their role in the entire supply chain and selling the semi-finished goods to the next level. Fourth is the transactional net margin method. This is the most selected TP method. The name highlights the word net margin. If you know the starting point in any tax computation, or the tax return will be net profits, right, as per the financial statements. So that's where the tax authorities are more interested in whether your net margins, which is the starting point, or what you are offering to tax, is aligned with the industry trends, industry margin trends. There could be scenarios where your transaction prices could be at arm's length, your gross profit could be at arm's length. Still, the entity might operate at losses at the net level. So that's where, while you might use the above two three methods as a primary analysis, still it is suggested to use transactional net margin, which entails net margin level comparison as a corroborative analysis, because that's the go-to method for the tax authorities. Then comes the profit split method. This is like a ghost in a transpricing context. Okay. At the back of the envelope, this is like the overall guideline method which is used, but from a compliance or a documentation standpoint, this is not widely used because this entails lot of metrics which will be available only to the taxpayers and not to the tax authorities. The way it works is, the word says that profit split. You have to allocate the profits of the system between the entities in the supply chain. Okay, so if you have a principal in US, if you have a regional trading hub in Singapore, if you have a procurement center in Philippines and a back office in Malaysia, based on their risk profiles, which is the functional assets and risk analysis, which is FAR analysis as per TP. You allocate the routine baseline return and see where which entities. Obviously, the principal or IP holding companies will get the residual. So it's more of a strategic tool, okay, to do effective tax planning at the back of the envelope. But from a compliance and a documentation standpoint, we use the other primary methods that we have discussed. Then there is a residuary method, which is the other method, which is like a open box, where you can't use any of the primary methods as most appropriate. Example, if there is any share transfer transaction, okay, the fair market value will be determined based on the valuation reports, right? Based on the independent valuer who is an expert on the subject. He might use a net asset value or a discounted cash flow or market comparables approach and determine the business value, thereby the equity share price. So that's where the valuation report, which might have been the underlying documentation for a tax or regulatory purpose, can still be used as a documentation for transferring, because the arm's length price is nothing but fair market value. But that valuation report is not fitting in any of the five methods that we have discussed. So that's where the residuary other method comes into play, which allows the taxpayers to use these sort of documents, which are open market or fair value documents, as supporting evidence to test the arm's length price under the TP regulations. So this is a summary of the transferring methods. Anyway, we'll have simple examples for each of the methods to give you more context of how these methodologies work. Now, on the arm's length range, uh, transpricing is not about the dot value or a pointed value. So, in our example of Philippines back office, we said cost plus 10% should be the arm's length markup for provision of services to the US parent, right? Now, how did you decide that 10% cost plus markup? So that is based on the benchmarking results, where we do TP database benchmarks using third-party database and arrive at a set of results. Say, suppose if we arrive at 10 data points, you can't pick a single data point from that. That's where the statistical rules come into play. It says that you arrange those data points, 10 data points, in a ascending order, and pick the interquartile range as the arm's length range. The Philippines guidelines typically allows 25 to 75th percentile as a arm's length range. Say if it is coming to say 8 to 12% as the 25th and 75th quartile, and median as 10. You can typically pick the median, which is 10 for the arm's length testing. So if your cost-based markup is falling below the range, which is below 8, then the authorities have power to adjust your results so that your actuals are bridged to the arm's length range. So this is only interquartile range, which is the arm's length range concept, which is there in the Philippines regulations. Next slide. Yeah. So I'll pass it to Rishabh to take over on the FAR analysis. Over to you, Rishabh.
Right. Thank you, Praneeth, for setting the context and the legal background with respect to how transfer pricing is being applied in the Philippines in context of either domestic transactions or cross-border transactions. So, what I am going to take up over here in the next couple of minutes is the basic three pillars of the transfer pricing analysis, which you saw initially in the transfer pricing life cycle, that we need to characterize each entity basis on what they do, because the margins that Praneeth was talking about is dependent upon what you actually contribute to the whole supply chain, right? So when we are talking about the contribution to supply chain, it comes from these three terms. So FAR stands for functions, assets, and risks. So these three things needs to be analyzed amongst all the group entities who are involved in the transaction or the related party transaction. So in our example, a Philippines trader or a back office service provider of a US headquartered multinational. So the services are being provided from a Philippines entity to a US entity. So basis this transaction information, we need to see what functions are performed by each of these entities, the Philippines entity and the US entity, what assets are owned by each of these entities, and what risks are undertaken by these each of these entities in performing such service or in in relation to the related party transaction. So once we know these three things about each of the entity, basis that we'll classify the entity, that who is the principal entity, who is a limited risk or a limited function entity. So when we say a back office in Philippines is usually a captive, limited risk entity of a US headquartered company, as we are taking in our example. So the limited risk entity should get, a fixed margin basis a cost plus approach or any of the other methods that we have seen in the previous slides. So the idea here is very simple, that we need to go and check what functions are performed. So basis, you are a manufacturer, distributor, or a service provider, all these three all these three transaction profiles are very prominent across Philippines. We have contract manufacturing as well in Philippines, so people setting up factories in Philippines. We have distributors as well, so people importing goods and distributing in the domestic market, and of course the service providers, be it in the nature of back office service provider or now knowledge process service providers or IT service providers. So all of these three, transaction profiles are very prominent. So we need to disseminate that what function is performed by which of the entities in the supply chain. Similarly, basis the assets, both tangible, intangible assets have to be disseminated in terms that which entity is owning which assets or using which assets. So in terms of using of a brand name, trademark, or a copyright, we pay royalties. So we need to see that who owns the intangible, who is protecting the intangible, versus when we are doing a contract manufacturing, we may be using a particular proprietary technology to do that manufacturing process. So we need to see who owns that intangible in those terms, because if you own an intangible, then you need to be remunerated to own that intangible if someone else is using that. So that is a typical royalty method when we look at in terms of what assets are owned by which of these entities. And finally, the risk profiles, because it is a very prominent business principle that the more risk you take, the more the more return you should get, right? So we need to see which entity is bearing what level of risk and can they control that risk. If yes, then basis that magnitude, they should be rewarded in terms of the return that they get from the supply chain, because we know that the overall profitability in the complete supply chain is fixed. So from the base cost of manufacturing a product to the final sales price to the customer, it is a fixed margin that you will generate as a group as a whole. But that margin is what we need to allocate to each of the entities based on the functions, assets, and the risk profile of each of the entities. Right. So these three pillars form the base of transfer pricing analysis in terms of what exactly each entity is doing and what and how much risk it is undertaking to perform that transaction. Once that is done, then that is the time when you can move on to the next step and decide that how much return needs to be allocated to each node in the supply chain. We've given certain typical profiles here. So when we talk about manufacturing, we have couple of profiles based on the typical functions, assets, and risk, and the business analysis that we've done. So we have toll manufacturers, contract manufacturers, then licensed and full-fledged manufacturers. So each of them having a different level of functions, assets, and risks, and accordingly, having different transfer pricing methods that can be used to do the transfer pricing analysis. Similarly, for distributors, you might have an agency model without having a full-fledged entity. Then you might have limited risk distributors who do not contribute on the marketing part. Then you have routine or full-fledged distributors who are undertaking more functions and more risks and work in a buy-sell model versus the other two that we've seen as an agency model, right? And similarly, of course, we have for service providers. So what we typically see in Philippines are low-end service providers. So when we say low-end, it really doesn't mean that we don't add value. We do add value to the overall group. However, these services that we provide as a back office are mostly supportive and non-core and auxiliary services. Thus, they fall under the low-end services. And then we have a full-fledged or high-end service provider. So when we, move to R&D, we move to tech, we move to ITES, information technology services. So that's when, high-end service provider profiles come into picture. Talking about a quick analysis on, how we go about doing the analysis once we have classified each entity in the supply chain. So we try and compare it with its peers. So when I say peers or external competitors, that is an external comparison that we are trying to do. Otherwise, there could be a situation where we have an internal comparison already available. So if I am a Philippines entity, a distributor, and I sell goods to both the same goods to both my related parties and independent parties as well or third parties, so then I have a direct comparison in terms of what should be the price or the margin on that particular product. And similarly for service providers, for manufacturers, uh, external comparison becomes essential when you are captive entities. So your 100% revenue or cost are coming from the related parties or the group entities in either scenario, right? So either I'm buying 100% goods from a related party to do distribution to the third parties, or I am a captive service provider sitting out of Philippines and giving 100% services to my group entities across the globe. So that's the point where the external comparison becomes essential. So you go out in a transfer pricing database, do certain sort of filtering, find out the comparables which or companies which are into similar sort of businesses in our geography or expanded geography based on how many companies do we get, and then we do the arm's length comparison of what Praneeth was mentioning, the interquartile range, calculating a particular ratio to see the profitability, so gross margin or net margin, either of the scenarios. That's an external comparison that we can do. So we have choices for both. Internal being more reliable, external, might have certain differences. So we need to adjust for those differences as well. However, when we talk about audits or when we talk about reviews with tax authorities do rely on external analysis or external comparison as well, because that shows what the broader industry is actually doing in terms of the business line that we are in. So we mentioned a couple of transfer pricing databases over here, wherein the majorly used databases in Southeast Asia are TP Catalyst, SNP, and OneSource. So these are by very big data service providers. So ranging from Moody's to Standard and Poor. So these are the major data service providers which have good coverage across Southeast Asia and majorly using TP Catalyst for the Middle East region. These Databases will have financial data for manufacturing, trading, and services as a transaction type. But when we go to specific transaction types, that's royalties, license fee, franchise fee, commissions, all of these things, then we need to see certain agreements which are found in databases like royalty stat and royalty range. They have transaction specific or deal specific data and agreements as well. Then when we go to financial transactions, so for loans, for corporate guarantees or any other sort of guarantee fee, then we have another database called Loan Collector or Loan Connector or Bloomberg. So that's where you get loan agreements, you get interest rates, you get those terms and conditions, because we need to apply similar terms and conditions, and we need to find companies with similar terms and conditions when we are looking to do a external comparison. Right, so these are the popular databases. Certain jurisdictions have their own local databases, like Malaysia. They have another database called SPIDA, which has Malaysian entities. So those can also be used, but from a global perspective and policy setting, these are the popular databases to be used to do an external analysis. We've given a small search strategy. I'll not delve deeper into that. Gets much more technical. So how we select the comparables, starting from the whole universe of companies that we have, filtering down to certain companies which are similar to what we do, is the overall idea that we need to get. And of course, we need to give reasons on why we are taking one of the companies as a comparable and why we are rejecting the others. Basis that a complete matrix is maintained, and again, all of these parts form parts of your transfer pricing report or the benchmarking report that is created for the transaction, right? I'll quickly talk about the compliances as well, especially from the Philippines standpoint over here. So, Form 1709 submitted to the BIR is the main compliance, uh, I would say, milestone, which has to be done by large taxpayers who have been officially notified, entities which are taking tax incentives, or entities which are into, 3 years into consecutive losses. And of course, you will file this form only when you have related party transactions. So even if you are falling under these categories to file form 1709, but at the end of the day, you have not entered into a related party transaction, then none of it has to be done, because there is no transaction to be reported in the form, and it's done with the annual income tax return of the taxpayer. And similarly, we have to maintain a transfer pricing documentation, parts of which already we have explained in terms of comparison method, transaction detail. So it's a complete set of documentation which shows how we have transacted, what was the transaction, which method was used, which database was used. So a complete detailed documentation for all the related party transactions of a particular taxpayer. We have given thresholds. There are, three prongs of the threshold. So it's a trident. So threshold on revenue. So 150 million of related party transactions of revenue and 90 million of related party transactions. Then we have transaction specific thresholds, so goods 60 million or services interest or royalty at 15 million. And these threshold needs to be checked for the prior year as well. So not in the current year only, but in the prior year as well. So if you have breached any of these thresholds in the previous year or previous tax period, you are still liable to maintain the transfer pricing documentation. And once the BIR asks for that documentation, you need to file that in the 30 days time period that is allotted. That's the maximum time period, that is allotted by the BIR to submit the transfer pricing documentation. Right. So moving forward, these are the deadlines, and we have just illustrated over here the importance of these deadlines. So 15 April for filing your form 1709, and 30 days to submit your transfer pricing documentation once asked by the Internal Revenue Services. Then, you need to attach these contracts, tax returns, and all of the supporting documents with this transfer pricing document. If not, then of course there is a fine and penalty for non-filing of the form from 1,000 to 25,000, and not doing these attachments, we have a penalty of 5,000 to 10,000. And then, of course, it's a criminal offense in Philippines, which is quite rare for civil crime or financial, not a crime but a financial lapse. So it is still a criminal offense, having 1 to 2 years of imprisonment. So moving forward, Praneeth, can you take up certain common case scenarios that we see in Philippines as a related party transaction?
Yeah. So in the paucity of time, I will pick the case study one. Rishabh, if you can present that. Uh, so this is again the back office example we spoke in the beginning. So the stepwise approach flows in this way. If you see the left side, there is a transaction flow which is outlined. Uh, the Tech Pro Inc. is the US holding entity, which is the principal entity, and we have Tech Corp Philippines back office, which provides ITES services, which is information technology and information technology enabled services. This Philippines entity is more of a cost center because it's fully capitally serving the US holding company. Now the US being a principal, which is in turn rendering services to the third party clients. So this is the transaction flow. Back office in Philippines, a principal entity, which is Holdco in US, which is also IP owning entity, which is also a client facing entity providing services to the clients. Now, once you have this case study before you, there are mainly 1 2 questions to be answered. First thing is Philippines being a cost center. If you see the P&L of Philippines, there are operating expenses of say 100. So this just dummies for the example, which includes the payroll cost and day-to-day operational expenses. So this 100 is cost base of the Philippines entity. This being a related party transaction scenario, to pay these expenses, it has to be remunerated by the principal because there is no other way of cash flows into the Philippines entity because it's purely a cost center. It's not providing services to any third party clients, only single client. It's their Holdco in US. Now, Holdco, being the client facing entity, is collecting the revenues from third party customers. So the principal will have to push that cash flows to the cost center in Philippines so that it meets that day-to-day expenses, payroll costs, running expenses. So in our example, which is 100. Now the second question is whether the US company should cross-charge or should pay for these expenses of only 100, or is there any markup or profit element that this cost center has to offer the tax in Philippines? So that's where TP regulations come into play. So from a business standpoint, you might think that as long as I remunerate the cost center at 100, it'll be able to meet it cash flow or the operational expenses. It should be fine. But you don't think of a profit or markup element because that's a tax cash outflow, right? That's where TP regulations come into play. It says that if you are an independent third party service provider, what you would have operated at, you would have obviously earned a net profit or a markup, right, on your cost base. So that becomes a comparability check. So that's the typical markup or margin range which would be expected even in a related party transaction scenario. So in our case, 18% was the markup. So you add this 18% on 100 and 118 will be your TP billing to US. Uh, this entire revenue. So if you see the PNL, 118 will be the revenue of coming from US. Operating expenses of 100, which includes both direct as well as overheads, and the markup of 18, which will be offered to tax in Philippines. Now on the 18% markup, how do you determine what are the key driving factors? One is the nature of the services. In our case, the ITS services will be compared to the broader IT sector or industry based on the TP databases, and we arrive that. So if it is a R&D, research and development, or KPO, knowledge process outsourcing, or a low-end admin or business support services, the markup ranges differ. Thumb rule is higher the intensity of functions. So R&D, KPO demand higher markup, lower the intensity of functions, which are your business support services or shared support services, be it your corporate functions like IT, HR, payroll, finance, legal. These sort of low end services will warrant a lower markup. So the categorization of services is a key factor. Second thing is a FAR profile. So in our case, we said it's a cost plus cost center, right? The entire strategy decision making is happening at a principal level. So the US entity could be characterized as a entrepreneurial or a principal entity, whereas the Philippines entity will be characterized as a routine cost plus service provider. That's why the routine markup will be given to the cost center. Any surplus profit or loss which is coming from the client billing will be sitting in the US entity. So that's the TP profiling layer, which again has a bearing on the markup that you are offering. Now, few checkpoints. One thing is service categorization has to be rightly captured in the intercompany agreements, because that will drive your uh, the markups. Second thing is the cost base, whether it has to be only payroll cost or overage. The cost base should be clearly defined. Uh, Third thing is uh, are there cases where you can carve out certain costs while billing? Of course, yes. There could be scenario where there is an ideal or bench cost. You know that there is this war scenario happening in which are emanating from Middle East, right? So there could be scenarios that US is not able to bill or engage the third party customers. So that's why the back end reliance on Philippines is not that much. So there could be ideal or bench cost which is there in Philippines. So if we can clearly track the timesheets and say that these are non-billable resources uh, which were not used for provision of services, we can carve out that non-billable cost from the cost base. So these are case-specific facts that we have to capture and accordingly try to build in your transparency policy. The last thing is the business objective. So you are offering in our example 18% to tax in Philippines, right? So there could be after tax profits which are getting accumulated in Philippines. So is there any repatriation mechanism so that you can the US can recoup this from Philippines? Yes, of course. So dividend could be one of the typical repatriation mechanism in a cost center, because you can't think of a pre-tax scenarios like say management fee, because in a cost center cost plus TP model, it'll have a circular effect. Any management fee that you pay, it again becomes part of your operating expense. Again, you have to charge whatever cost plus markup and bill it to US. So it will have a circular loop. So only option repatriation option will be the dividend as a repatriation mechanism. So from a litigation or audit defense standpoint, have appropriate intercompany agreements which drive the TP policy. Ensure that you're doing timely complaints, because non-compliance in itself will be viewed negatively by the tax authorities. And of course, always substance or form, actual conduct or contract should be the thumb rule. So this is one of the example. Rishabh, over to you to give final concluding thoughts of our session. Yeah.
Right. Thank you, Praneeth. So, before we stop for the Q&A, these are certain misconceptions that are usually there around Philippines transfer pricing, and we have collated here. And a lot of your questions might already get answered because these are the common ones that we get. So, the main one being that that transfer pricing applies only to cross-border transactions. No, that we have already seen that it is also applicable to the domestic transactions as well. Another mismatch over here remains that, okay, I'm showing certain entities as related parties as per the accounting standards, Philippine accounting standard 24. Whether is it enough or not, we need to make sure that, the related party relationship or the definition that is given for the transfer pricing regulation is way more detailed than what is there in your Philippines accounting standard 24. So yes, there might be entities which are not related parties as per the accounting standards in the financial statements, but they are related parties for the corporate tax or income tax disclosure in Form 1709 and the transfer pricing documentation. Another myth is on the documentation only be filed with the BIR annually. So the detailed documentation is not to be filed, it's to be maintained and has to be updated regularly year on year, and is only to be filed within 30 days when we get intimation from the BIR. So yes, we need to have it because 30 days becomes too tight when the tax authority is to start asking the detailed documentation, especially when you have multiple transactions. Uh, Next one is that the documentation needs to be updated only when there is a significant change. The idea over here is that the law states contemporaneous documentation, so it needs to be updated annually, even for financial numbers or addition of any other transaction or change in the functional profile of the entities. So irrespective if everything is constant, still you need to update your documentation year on year and to update for the financial numbers. Um, Another one is that the BIR will continue to follow the same transfer pricing method. No, the tax authorities or the Internal Revenue will do their own independent analysis with respect to what is the correct method. So that is the base level of the review that will go to. So what is the method for a particular type of transaction? And last one, that only Philippine comparables are mandatory. So there is no legal requirement for that. But yes, the tax authorities do prefer to have local comparables from Philippines. But if you do not have enough comparables, the business is niche, so then we can expand to regional and global comparables. That's there from our end. We have tried to cover a lot of aspects and give you an overview of Philippines transfer pricing. And we take a quick pause for any questions and answers, questions that you have. So either you can use the chat box, or probably you can just raise your hand and you can unmute and ask your questions.
All right. Thank you very much for that comprehensive presentation. We'll now move on to the Q&A. So go ahead, Jesse.
All right, so any questions from our participants? Questions or concern, this is your time to chat it in our chat box, or you can unmute yourself to talk to our speakers.
I know we've given a lot of information in a very short time, but the idea is to educate you on the lines that these are the important aspects and they turn into significant risks. Yeah.
Perhaps I have a question because we're on the topic of risk. So what would you guys consider to be, let's say, the top three red flags when authorities are doing an audit on transfer pricing?
So, Aaron, to answer your question, so it really depends again on the business model. But now, what we're looking as a trend globally, and especially in Southeast Asia, so transfer pricing litigation by tax authorities is pretty new, and it's upcoming, and it's only been about 5 to 6 years of the framework that has come into picture. But as a trend, we are now seeing a lot of audits around the financial transactions, so not just the interest rate, but also how the entity is funded, whether in an independent scenario, a bank would fund that entity with such a debt, because we all know that interest is a tax deductible payment versus dividends. So financial transaction is one key area. Second key area, of course, is on the markups that we are applying on the cost base in a contract manufacturing or in a back office scenario of services. So whether it has to be 8 to 12% markup, or it has to be a 12 to 18% markup based on the functional profile and the category of service. And the third key area is coming on what costs are you including? Whether these costs actually needs to be recharged to your related party, or they need to be borne by you. So what costs precisely are being included in the cost base on which the markup is applied? Because higher the cost, higher the markup in absolute values, and higher would be your taxable income in Philippines. So that is the idea of the tax authorities in order to determine. So I think these are the three key areas as of now. Praneeth.
Yeah. So just to add on, I will highlight 3 points. One is non-compliance or weak documentation. As I've highlighted, non-compliance in itself will be viewed negatively by the tax authorities. So it's important to track the thresholds, timelines, and ensure timely compliance. That's one thing. That's a big red flag. Second thing is the loss-making entities. So if you have related party transactions and are operating at losses and net level, they'll be under radar to substantiate whether these are bona fide business losses or it's because of mispricing your intercompany transactions. Third is wherever you have this repatriation mechanisms, be it your royalty or management fee or interest cross charges, which are cash outflows from the jurisdiction from Philippines to overseas countries. So that's where, in addition to the transpricing arm's length test, they also see the benefit evidence test documentation because you're reducing the tax base in Philippines to that extent, right? By paying out these expenses to your group entities. So these two, three are the key red flags, I would say. Yeah.
All right. Thank you so much. Any other questions or concern? Okay. So let's all appreciate Mr. Praneeth and Sir Rishabh for this wonderful and informative talk. So moving forward, Sir Aaron.
All right. So I just want to give a quick shout out again to MGB, Master Global Business, for connecting myself and Rishabh. So again, Rishabh and I are both members of MGB, which is a B2B networking platform. And I am just so glad to be connected with Rishabh and Praneeth so that if I have any clients that require global transfer pricing expertise. And ThinkTank does have multinational clients where services are being sold from one entity to another. Then we can always rely on the expertise of Rashab or any other of our MGB members. So again, MGB follows the one country, one member principle. So ThinkTank represents the Philippines, Rashab represents the UAE, we also have experts from other countries like from Thailand, from Vietnam, from the Netherlands, even in Africa. So if you are interested in joining our organization and be connected with other B2B professionals, in this case, in the accounting, tax, and compliance realm, then feel free to contact myself or any of our think tank staff after this presentation. So moving on, going back to you, Jesse.
All right. So thank you for joining us today, and we hope that you learned a lot from our speaker. To help us improve our trainings, we would like to get your feedback for today's session. Transfer pricing in the Philippines, laws and practices. Kindly scan the QR code to provide your feedback. And now our new offering, prestigious virtual office address in the Philippine Stocks Exchange. Avail our virtual office address for your business registration needs. Our service offers secure and efficient mail handling and flexible plans tailored to fit your business. Elevate your business presence today and join us at Philippine Stocks Exchange. So again, thank you so much, everyone.
Thank you, Aaron. Thank you, Jesse, for this wonderful webinar. We really appreciate the collaboration.
All right, sir.
Thank you. Have a great day.
Yes, thank you so much, Rashab and Praneeth, for joining us in our maiden think tank and MGB collaborative webinar. And again, for everyone in this room, if you want more information about global transfer pricing services or any of our services in think tank for accounting, tax advisory, or compliance, our contact information is in the slide right there. All right. So thank you very much for joining. And everyone have a good afternoon, good night, or good morning. Cheers. See you in the next webinar.
Thank you.
Bye, guys.